Good morning, afternoon, evening to everyone tuning in. We're standing at a fascinating crossroads in the markets. If you look around, you'll sense the tension. Caution is high, sentiment is wary, many are still asking, is the worst behind us? Today I'd like to make a bold claim: the worst is over, and more importantly, that means the clock is now ticking on one of the most compelling windows of opportunity we've seen in recent years. The world is quietly changing beneath the surface. Many don't see it yet, but the signs are all around us. The financial system that once looked stable, predictable, and dominant is showing visible cracks. For decades, the world has been anchored to one dominant currency, a system that gave the illusion of permanence. But no currency holds eternal power. Every cycle of history reminds us that leadership in money, like leadership in technology or geopolitics, eventually shifts. The question is not if, but when. And those who fail to diversify before that shift unfolds are often the ones left behind, wondering how the obvious escaped them. Relying on a single currency has always been a comfortable illusion. It feels safe because it's familiar, but safety built on dependence is fragile. When governments print aggressively, when debt levels rise to unsustainable heights, and when central banks start to intervene in markets daily just to hold the system together, that's not stability, it's control, and control by its nature is temporary. True stability doesn't come from manipulation, it comes from resilience. And resilience means choice. It means having alternatives, flexibility, and assets that can weather transitions. Look back through history, every monetary regime has had its rise and fall. The British pound, the Dutch guilder, the Spanish silver standard, even earlier systems built on gold or barter. The pattern is the same: confidence grows, expansion follows, then overreach begins. Eventually, the trust that once fueled the system starts to erode. That erosion happens slowly, almost invisibly, until one day the world wakes up and realizes the foundation has shifted. Right now we're living through that same pattern, only faster. Because technology accelerates everything. Digital assets, decentralized systems, and alternative stores of value are no longer fringe ideas. They represent a fundamental rethinking of how value moves, how wealth is stored, and how power circulates. The next generation doesn't trust a system where value can be inflated away with the push of a button. They're building something new, transparent, borderless, and digital first. And that shift won't be reversed, it's structural, not cyclical. This isn't to say that traditional currencies will vanish overnight. They will remain essential for commerce, policy, and liquidity. But as investors, we have to see beyond the surface. The concentration risk of being tied to one currency, in assets, in savings, in mindset, is enormous. Diversification isn't just about holding multiple stocks or sectors. It's about hedging against the slow decay of purchasing power, about positioning for new systems of exchange that will dominate the next era. The irony is that while many still anchor their faith in central banks, the most innovative companies in the world are already operating in a multi-currency, multi-asset reality. Whether it's digital payments expanding across borders, blockchain infrastructure replacing intermediaries, or commodity-backed digital tokens offering stability where fiat falters, the change is already happening. It's the same kind of disruption we've seen in every other industry: decentralization, transparency, and technology replacing inefficiency. In times like these, opportunity hides in plain sight. When fear rises, people retreat into the familiar. They cling to the currency they've always known. But that's not where growth comes from. Growth comes from foresight. It comes from understanding that innovation always starts as an alternative, then becomes the standard. The early adopters of this mindset, those who embrace new forms of value, will not just protect their wealth, they'll expand it. What we're witnessing isn't the end of money, it's the reinvention of it. The next phase will not be defined by one dominant reserve, but by multiple systems coexisting, competing, and evolving. That kind of world rewards flexibility. It rewards those who can pivot, who think globally rather than nationally, and who invest in the technologies that make this transformation possible. So the message is simple but urgent: don't rely on one currency. Don't anchor your financial future to the assumption that the system you grew up with will be the same system your children inherit. Think beyond the next quarter or the next rate cut. Think in decades, in innovation cycles, in paradigm shifts, because that's where the real wealth is built, quietly, patiently, and courageously, while most are still holding on to yesterday's idea of safety. The future doesn't belong to those who cling to comfort. It belongs to those who understand that resilience is not built by dependence, but by adaptability. And right now, adaptability means embracing a world where value no longer has one face, one flag, or one currency. It means stepping into the unknown, not because it's easy, but because that's where progress always begins. In moments of uncertainty, the temptation is always to chase numbers on a screen, digital balances, short-term trades, portfolio swings. But real wealth isn't found in fluctuations, it's found in ownership. Not the illusion of ownership that exists through synthetic products or financial engineering, but the kind that holds substance. Assets that endure through inflation, policy shifts, and cycles of fear. Real things, innovation, land, commodities, infrastructure, intellectual property, technology, and even ideas, are the foundation of resilience in a world that's increasingly virtual. For years, markets have rewarded those who trade abstractions, leverage, derivatives, speculative instruments, all built on faith that liquidity will always be there when needed. But that faith is being tested. The more the system depends on promises rather than production, the more fragile it becomes. And when fragility collides with reality, when currencies wobble, when debt piles up, when confidence fades, the only assets that matter are those rooted in something tangible. Owning real things is not about fear, it's about perspective. It's about recognizing that intrinsic value doesn't evaporate when sentiment changes. When you own innovation, you own productivity. When you own commodities, you own scarcity. When you own intellectual property, you own the capacity to create. These are not paper promises, they are the building blocks of a functioning economy. They generate value whether the markets rise or fall, because they serve real human needs. There is a subtle but powerful shift happening in the global economy, a rotation from speculation to substance. The easy money era taught investors to believe that everything could be financialized, that returns could be manufactured indefinitely. But the truth is resurfacing. The companies that actually make, build, and solve are regaining importance. The market is rewarding those who innovate, not just those who repackage. We're seeing it across sectors, from energy transformation to robotics, from advanced manufacturing to next-generation computing. The lesson is clear. Value is flowing back to the tangible. Even technology, often seen as abstract, is a real asset when grounded in genuine productivity gains. Software that automates work, AI models that accelerate discovery, platforms that reduce friction. These are digital infrastructures as real as any factory floor. They are the new machines of the modern age. When you invest in them, you're not speculating on sentiment, you're participating in the architecture of the future economy. At the same time, commodities and resources are reasserting their role. For years, they were ignored under the weight of cheap money and deflationary trends. But the world is waking up to the reality that every technological leap still depends on physical inputs. Lithium for batteries, copper for grids, silver for electronics, rare earths for computing. The digital future cannot exist without material foundations, and those who own these foundations will shape the direction of progress. Owning real things also means owning conviction, because in every cycle, there are moments when the crowd panics and sells what is real to chase what looks easy. That's when patience becomes power. Real assets test you. They don't move every day, they don't react to every headline, but over time, they compound value in ways that speculation never can. And beyond markets, there's a deeper truth. Owning real things connects us to purpose. It forces long-term thinking. It demands stewardship. When you own something real, a business that creates jobs, a technology that changes lives, a resource that sustains industries, you're part of building, not just benefiting. Ownership becomes participation in progress. This is the mindset that separates short-term traders from visionary investors. It's the difference between chasing cycles and shaping them. Because in every era of transformation, those who owned the real engines of growth, not the noise, not the speculation, emerged with enduring wealth and influence. The illusion of value built on leverage and liquidity can disappear overnight, but real things endure through inflation, through recession, through policy missteps, through fear. They may fluctuate in price, but their worth compounds over time, quietly, consistently. That's how generational wealth is built, not by timing perfection, but by owning reality when others are chasing illusion. So, when the world feels uncertain, that's not the time to retreat. It's the time to own. Own the technologies shaping the future. Own the resources that fuel them. Own the ideas that redefine industries. Because when the dust settles, when systems shift and cycles reset, what remains standing are always the real things. The world doesn't reward those who merely speculate on the surface. It rewards those who hold the foundation, the tangible, the transformative, the essential. In an era defined by digital noise and monetary distortion, the wisest move is surprisingly simple: own what's real. In every era of investing, one truth quietly separates the survivors from the casualties: concentration builds wealth, but diversification preserves it. The future is always uncertain, and while conviction drives innovation, protection ensures endurance. Diversification isn't about fear, it's about adaptability. It's the recognition that the world moves in unpredictable waves, that progress rarely unfolds in straight lines, and that resilience is built not by avoiding risk, but by balancing it. We live in a world that changes faster than any model can predict. Technology disrupts entire sectors overnight. Policies shift. Geopolitics rewire supply chains. Energy transitions reshape industries. And markets, as they always do, swing from optimism to despair in a heartbeat. No single idea, asset, or currency is immune to that volatility. To survive, to grow, and to stay invested through the noise, diversification becomes not a defensive move, but a strategic one. There's a misconception that diversification means dilution, that spreading across multiple assets somehow weakens conviction. But that's a narrow way of looking at it. True diversification isn't about owning everything. It's about owning different kinds of risk. It's about holding assets that behave differently in different conditions, so that when one part of the world falters, another quietly strengthens. It's the architecture of stability in an age of disruption. The market rewards boldness, but it punishes fragility. Concentration in a single sector or theme can seem brilliant during expansion, but becomes brutal during contraction. The investors who endure are those who balance innovation with optionality. They understand that cycles turn faster than narratives, and that diversification is the only constant hedge against surprise. Even within innovation itself, diversification is crucial. The future isn't powered by one technology, it's a convergence of many: artificial intelligence, robotics, genomic breakthroughs, next-generation energy, blockchain infrastructure. Each represents a different path to exponential growth. No one can predict which will dominate first, but together, they form a web of opportunity resilient enough to survive any single failure. That's the power of diversification within conviction, not abandoning the future, but widening the lens through which we invest in it. History offers countless reminders. Every major financial collapse had one thing in common: overexposure to a single idea that seemed unbreakable at the time. Whether it was housing in 2008, tech in 2000, or debt in the 1980s, concentration turned confidence into catastrophe. The investors who stayed standing weren't necessarily the ones who predicted the crisis. They were the ones who spread intelligently, who hedged, who allowed space for the unknown. In today's interconnected world, diversification goes beyond geography and sectors. It means diversifying across systems, traditional finance and digital assets, developed markets and emerging economies, tangible assets and intellectual capital. It means understanding that the future of wealth creation is multi-dimensional. The borders between asset classes are dissolving, and investors must evolve with them. Diversification also protects the most valuable asset of all: time. Because when a portfolio is balanced, you can stay invested longer. You don't panic during drawdowns. You don't sell in despair. You allow compounding to do its work. The most powerful engine of wealth isn't timing, it's duration, and diversification is what gives you the patience to endure. What's often overlooked is that diversification fuels innovation. When investors feel protected, they take more intelligent risks. They allocate to visionary ideas without fear of ruin. They can back technologies years before they become mainstream because they've built a structure that absorbs volatility. That's how real progress happens, not from avoiding risk, but from managing it so that boldness can thrive. It's easy to become obsessed with what's winning now, to chase momentum, to concentrate where returns seem obvious. But markets have a way of humbling certainty. What leads today can lag tomorrow. The companies or assets dismissed in the shadows can suddenly become the next cycle's leaders. Diversification keeps the door open to those possibilities. It allows participation in the unknown, the innovations no one sees coming yet. Protection isn't about playing small, it's about staying in the game long enough to win big. Every innovation cycle tests conviction, every downturn tests patience, and every recovery rewards those who positioned early but wisely. Diversification is what bridges those phases. It keeps you from being forced out when volatility strikes. The goal is not perfection, it's participation. It's about aligning across different frontiers of growth while minimizing exposure to any single point of failure. Because the future won't reward rigidity, it will reward flexibility, and diversification is flexibility engineered into a portfolio. So, as the world transitions through economic realignments, as new technologies challenge old hierarchies, as inflation and deflation alternate their grip, the wisest move remains timeless: build a portfolio that can breathe, own innovation, own resources, own stability, build layers, not walls. Because protection isn't the absence of risk, it's the capacity to endure it. In the end, the greatest investors aren't those who predict the next wave perfectly, they're the ones still standing when the tide turns. That endurance doesn't come from luck, it comes from design, and that design is called diversification. Every generation believes its moment is unique, that the patterns unfolding before it are unlike anything seen before. But the truth is, the world moves in cycles, long, powerful, structural cycles that repeat with rhythm and precision, even if the players and technologies change. The names evolve, the tools improve, but human behavior, optimism, fear, excess, and correction, follows the same cadence. To build lasting wealth, to build conviction, you have to think in decades, not months. You have to see beyond the noise of the moment and into the architecture of long-term cycles. The short-term mindset dominates modern markets. Screens flash by the second, headlines shift hourly, and data is interpreted like a scorecard of instant success or failure. But the real forces shaping economies and industries don't move at that speed. Innovation, productivity, and demographic change unfold over years. Monetary systems evolve over generations. Paradigm shifts happen slowly, and then suddenly all at once. Those who think long-term can see the turning points before they become obvious, because they understand where we are in the cycle. Every long-term cycle has the same anatomy. It begins with innovation, a breakthrough, a disruption, something that redefines what's possible. Then comes expansion. Capital flows in, growth accelerates, optimism surges. Eventually, excess builds, valuations stretch, leverage expands, then reality catches up. A contraction, a correction, a cleansing of the system. It feels painful, but it's necessary. It resets the stage for the next great wave of growth. These cycles are not accidents. They're how economies breathe. The mistake most investors make is believing that every downturn is permanent. They anchor to fear, not realizing that contractions are the seeds of the next expansion. The technologies that seem risky today often become the backbones of tomorrow's growth. The same way the internet emerged from the wreckage of the dot-com crash, the next wave of innovation will rise from the correction we've just lived through. Thinking long-term means having the patience to see that cycle through, to understand that progress never moves in a straight line. Right now, we're standing at a fascinating intersection. Many see volatility, I see transformation. We're exiting one long cycle, the era of cheap money, globalization, and centralized finance, and entering another, an era defined by decentralization, automation, and digital intelligence. These shifts don't happen overnight, but when they do, they redefine everything, from how we produce and consume to how we store value and measure wealth. Thinking in long-term cycles also changes how you interpret pain. Drawdowns aren't just setbacks, they're recalibrations. They clear inefficiencies, reward real productivity, and expose what was unsustainable. When you invest through a long-term lens, you start to welcome these phases because you know they create opportunity. When the short-term thinkers are panicking, the long-term thinkers are building positions. That's the difference between trading moments and investing in eras. Consider history's greatest wealth creators. They didn't time every move perfectly. They simply positioned themselves correctly in the long-term cycle and held through the noise. They invested in innovation before it was fashionable, in transformation before it was profitable, and in conviction before it was comfortable. That's how compounding works, not just mathematically but philosophically. Compounding rewards patience, not perfection. Thinking in cycles also means accepting change. The companies, currencies, and institutions that dominate one era rarely dominate the next. Every cycle brings new leaders. The ones that rise understand technology and demographic shifts. They adapt faster than their predecessors. The investors who win are the ones who spot those new leaders early, before the crowd, before the headlines, before the data confirms it. That's what it means to think long-term, to position ahead of time, not after confirmation. Short-term thinking makes people chase comfort. Long-term thinking forces them to embrace discomfort, because true opportunity always feels uncertain when it first appears. The early phases of a new cycle are the quietest, often ignored or ridiculed, but that's where exponential growth begins. The irony is that by the time most people feel safe to participate, the majority of the gains have already been captured by those who had vision when it was hardest to have it. Cycles are natural, but conviction is a choice. You can choose to be reactive, jumping from one narrative to the next, or you can choose to think structurally. The world rewards those who can step back from the noise and see the bigger rhythm. Because once you understand that history moves in waves, volatility stops being a threat. It becomes an invitation. So think long-term. Think in decades, not quarters. Look for patterns that outlast policy cycles and market moods. Invest in the future that's forming, not the one that's fading. Every great transformation begins quietly, during the downturns, when most are distracted by fear. That's when the next cycle is born. The secret isn't timing every movement. It's recognizing the melody behind it. The market doesn't move randomly. It moves rhythmically. Those who listen closely, who see through the noise, can build something that not only survives the storms but thrives through them. Because the real power isn't in predicting cycles, it's in understanding them, positioning through them, and letting time do what time always does: reveal the truth.